Please tell me, am I audible properly?
Yes, ma'am.
Yes, ma'am.
Okay, great. So let us start with our session for today. So I'll be taking your session on financial reporting, which will include 4 accounting standards. Ind AS 103, which is about business combination. Ind AS 36, which talks about impairment. Ind AS 113, which talks about fair valuation. And Ind AS 109, which is everyone's favorite, Ind AS on financial instruments. Okay, so we are going to cover these 4 Ind AS during our 3-hour session, which is from 9:30 to 12:30 onwards. I'll try to cover both the aspects, practical and the theoretical aspects both. Okay, so before I start sharing my PPT, I'll give my introduction and then we'll move ahead. So my name is CA Neha Bansal. I'm from Delhi. I completed my CA in November 2013, and then after completing CA, I joined EY. I worked with EY in this IFRS domain for almost 5 years, and now I'm working with a manufacturing company in Delhi itself. And here also I'm working as a technical accounting, and I'm taking care of IFRS, US GAAP, and Ind AS implementation in the organization. So my total post-qualification experience is approximately 8 years, and my complete experience is into IFRS, Ind AS, and US GAAP only. The major clients that I have dealt with is about Paytm. I have worked with one of the subsidiary of ITC, which is a travel company. Then apart from that, I have done Ind AS or US GAAP conversion for various other manufacturing companies as well. So this was about me. Now I'm going to share my screen and let us start with Ind AS 36. Is my screen visible? I hope my screen is visible.
Yes, ma'am.
Okay. So moving on to our first topic for today, which is impairment of assets. This is Ind AS 36. So in this topic of Ind AS 36, we are going to discuss that when are we going to impair an asset, how we are going to recognize the impairment loss. So let us start with this topic. So first of all, what is the objective of this topic? The objective of this topic is to ensure that in a company's financial statement, there should not be any asset which has a carrying value more than the recoverable amount. So that means if you go and sell an asset in the market, so suppose if the carrying amount is 100 rupees, but if you go and sell that asset in the market today, if your recoverable amount is 90 rupees, so that means you have overstated your carrying amount by 10 rupees. So there your impairment loss comes into picture, and this means that if your carrying amount is more than the recoverable amount, you need to impair your asset. So this is what the objective of this standard is. The objective of the standard is to prescribe the procedure that an entity applies to ensure that its assets are carried at no more than their recoverable value. Now moving on to the scope. This standard shall be applied in accounting for the impairment of all the assets other than inventories, because for inventory we have a separate standard. Contract assets and assets arising from cost to obtain or fulfill a contract under 115, because again these assets are covered under a separate accounting standard. Deferred tax asset, again they are covered under a separate accounting standard. Asset arising from employee benefits, again they are covered under a separate accounting standard. Financial assets which are under the scope of 109, because they are governed by a separate accounting standard. Investment property measured at fair value, because they are again covered at in a different accounting standard. Biological asset, deferred acquisition cost, and intangible assets arising from an insurer's contractual rights under insurance contracts, they are covered under the scope of 104. And your non-current assets which are covered under Ind AS 105. So that means this standard of Ind AS 36, this is applicable on all the assets, provided a certain category of assets which are covered under any other accounting standard. So here, if you see, we have excluded the assets which are covered under any other accounting standard. That could be your 105, 109, 104, 115, or any other asset for that matter. Now let us understand the most important definitions of this standard, because this standard is completely based on these three definitions. First one is the impairment loss. As we have already discussed, what do we mean by impairment loss? The definition of impairment loss is when the impairment loss is basically the amount by which the carrying amount of an asset or a cash generating unit exceeds its recoverable amount. So like the example which I took, if you have an asset which has its carrying value of 100 rupees, however, if you say that the recoverable amount of that asset is only 90, so that means you need to recognize impairment loss of 10 rupees. Now coming on to the next definition, what do we mean by the recoverable amount? Recoverable amount is the higher of its net selling price. What do we mean by net selling price? That is fair value less cost of disposal. Fair value, what do we mean by fair value? We will be discussing that in standard 113, because that standard completely talks about your fair valuation. Less the cost of disposal. So what all will be there in your cost of disposal? What all will be covered in your cost of disposal? That we are going to discuss in detail. Plus its value in use. So value in use also we will discuss how to calculate this value in use. So net selling price means your fair value, which we are going to discuss under section 113, less the cost of disposal. Cost of disposal also we will discuss that what all are included under cost of disposal. Then what do we mean by value in use? This also we will discuss in detail. So let us understand what do we mean by value in use. Value in use is basically the present value of future cash flows expected to be derived from an asset or a cash generating unit. So that means, suppose if there is a company who has a plant and machinery, the carrying amount of that plant and machinery is maybe 1 crore rupees. Now the company has to assess what is going to be the future cash flows from that plant and machinery. So what the company will do, present value of future cash flows means you have to first of all assess what is going to be your future cash flow for maybe next 5 years or 10 years, depending on the carrying value, depending on the useful life of the asset. And then you need to do the present value of that amount. So suppose, as I mentioned, the carrying amount of that plant and machinery is 1 crore rupees. But when you do the present value of future cash flow, it comes as maybe 90 lakh rupees. So then in that case, it means that your carrying amount is greater than your value in use. So again, it comes that you need to impair the amount. You need to impair your asset. So here it says that if value in use of an asset cannot be measured, then the recoverable amount will be equal to the net selling price. So let us go through these definitions once again. Impairment loss, amount by which the carrying amount of an asset or a CGU exceeds its recoverable amount. That means carrying amount is greater than your recoverable amount, then the impairment loss should be recognized. Next is recoverable amount. Recoverable amount is the higher of the net selling price, that is fair value less the cost of disposal and its value in use. What do we mean by fair value and the cost of disposal? That we will discuss in our upcoming slides. What do we mean by value in use? Value in use is the present value of the future cash flows expected to be derived from an asset or a CGU is called as your value in use. The standard says if the value in use of an asset cannot be measured, recoverable amount will be equal to the net selling price. Now let us understand what do we mean by a CGU. Let us understand this with the help of an example. I hope my Excel file is visible. So here I have taken an example that there is an airline company which has 4 aircrafts. Aircraft 1, which is operating with license 1, aircraft 2, which is operating with license 2, aircraft 3, which is operating with license 3, and aircraft 4, which is operating with license 4. So now here I have taken two situations. First situation is aircraft 1 can operate with license 1 individually. So that means the revenue that aircraft 1 earns with license 1 is not related to the other aircraft and the other licenses. So that means here in this case, aircraft 1 plus license 1 will be considered as one asset. That is, they are an individual asset. However, if we say take another situation, and the situation is aircraft 1 can operate with license 1 if they run all the aircrafts, that is A2 with L2, A3 with L3, and A4 with L4. And what could be the probable reason why this condition has been put? Maybe the location at which license 1 is operating, maybe that could be the most profitable location. So that is why, and your location 2, 3, and 4 might not be that much profitable. So that is why the government has put this condition that we will allow you to operate at location 1 only if you will operate at location 2, 3, and 4. So that means now the revenue that we will earn from location 1 will be dependent on location 2, location 3, and location 4. So here we cannot say that we have one single asset over here. No. Here we will say that we have a cash generating unit, and that cash generating unit will have all the 4 aircraft under it. Why? Because here aircraft 1 is not able to independently earn money or earn revenue. That is why we say that now the revenue earning is dependent on the other aircrafts also. So that is what we mean by your cash generating unit. Any question anyone have on this example? Okay, I'm presuming that no question is there. Now let us see the definition of cash generating unit. So the definition of cash generating unit is the smallest identifiable group of assets that generate cash flows that are largely independent from other assets or the group of assets. So that means, like, if I go to the same example, so here what was happening was the revenue from aircraft 1 was dependent on your other aircraft. So that is why we say that these 4 aircraft will be considered as one CGU. Now let's see how we need to work around the CGUs. So what we need to do for a CGU, we need to first of all determine the recoverable amount for the individual asset if possible. If it is possible, then yes, we will calculate the recoverable amount for that specific asset. However, if it is not possible to assess the recoverable amount for one individual asset, then we need to apply the CGU concept if the asset's recoverable amount cannot be estimated. That means, first of all, we need to try and calculate the recoverable amount for one individual asset. That means if we go back to this example, in situation A, aircraft 1 is operating individually. So that means in this case, our first case will be applicable, that you will be able to determine the recoverable amount from an individual asset. What is an individual asset in this case? Aircraft 1 is an individual asset. So since aircraft 1 is operating individually, so we will be able to determine the cash flows accordingly. However, here it says apply the CGU concept if the assets recoverable amount cannot be estimated. So that means now in the second situation, we have our CGU. Why? Because your aircraft one license is dependent on the other licenses also. So here it says if it is not possible for you to estimate the recoverable amount of one specific asset. Why it is not possible for to estimate? Because now we have a CGU instead of a specific asset. So that is your situation 2, where we have one CGU instead of one asset. So here it says that if it is not possible to estimate the recoverable amount of one specific asset, that is, if it does not generate cash flows independent from other assets. Same thing happens in our this situation 2. In aircraft 1 cannot generate the revenue which would be independent from the other assets. No. Aircraft 1 revenue is dependent on the other aircraft and their licenses. So that is why that is called as our CGU. And here, if the asset does not generate cash flows independent from other assets and in value in use, cannot be estimated to be close to their fair value less cost to sell. So that means what do we need to do? First of all, we need to see if it is possible for us to estimate the recoverable amount of asset. If yes, well and good. Let's go for it. But if it is not possible for us to estimate the recoverable amount of one specific asset, then we need to see that if it is possible for us to estimate the recoverable amount of a CGU. If that is possible, then yes, we need to identify the recoverable amount of a CGU. Any questions so far? Okay. Now let us understand, as per Ind AS 36, there are various internal and external indicators for assessing whether impairment is required or not. So let us first understand what all are the external indicators. First indicator is significant decline in the assets value. There has been significant decline, maybe because of that could be because of technological changes, that could be because maybe the new variant has come. So that could be for any reason. Or maybe the demand is not there for that asset. Maybe like if you have purchased an iPhone, okay, every year iPhone comes up with a new phone. So that means the value of an iPhone which was launched 5 years back may not be there in the market, because whosoever would like to purchase an iPhone would like to go for the latest technology. So that is what it says, a significant adverse change in the market to which an asset is dedicated, or in the technological, economical, or regulatory environment in which the company operates. What does this mean, regulatory environment in which the company operates? It means that, let's take an example, that suppose if the company is operating in SEZ zone, now government has brought some regulations which are specifically applicable for SEZ zone. And because of that government regulation, the company is getting severely impacted. So what will happen is if the company will get impacted, its business will get impacted, and in return its assets will get impacted, because we will not be able to do that, generate that much cash flows that we were generating before that regulatory pronouncement came. So that is again an external indicator. Next one is an increase in interest rate or other market rate of returns that affect the returns required on the company's asset. For this, maybe we can take an example that suppose as of today, we have maybe certain debentures on which we are giving the interest of maybe 8%. Suddenly what has happened? The government has increased the rate of interest. Now, generally on the FD, we get maybe 5% rate. But due to the increase in the rate by RBI maybe has increased, I'm taking an hypothetical situation, RBI has increased the rate of interest on FDs maybe 9%. So then what people will say, why will we will invest in the company? We will go for a risk-free return of 9%. So there the demand for those investments will come down. So because the people will go towards the risk-free rate of return. So here it says an increase in interest rate or other market rate of return that affect the return required on the company's asset. Why? Because now investors will demand that we are already getting 9% on FD. So you need to give us more return. Next is the company's reported net asset exceeds its market capitalization. That means the carrying amount of your assets less the liability exceeds its market capitalization. Yes, let's understand the external indicator with the help of an example. So Gibbon owns a 60% holding in Pickett, an unquoted entity. Both entities operate in a country with a stable economy. The government of the country has recently announced an increase in the interest rate. The increase will cause a fall in value of equity holding. This is due to the fact that interest-free investments offer a higher return, making them relatively more attractive. The market value of equity will adjust downwards to improve the return available on this sort of investment. So here it says the increase is an indication that Gibbons holding in the Pickett might be impaired. Gibbons should make a formal estimate of the recoverable amount of this interest in Pickett. Why this has happened? Because government has increased the interest rate, and now this investment of that is 60% in Pickett will become less attractive, because now people or the company would like to make more and more investments in your risk-free investments. Now moving on to internal indicators like obsolescence or physical damage affecting the asset. Like if I take an example, suppose there's a company who has issued a laptop to an employee, and by mistake, the employee, maybe he has damaged the laptop. So this is an internal indicator because this has happened because of that employee. So because if that is the case, if the carrying amount of that asset as on today was 10,000 rupees, but now because of that physical damage that has been caused by an employee, we are saying that we won't be able to recover more than 2,000 rupees. So that means we need to do the impairment of that asset by 8,000 rupees. But this is not an external indicator because this has happened because of the employee of the company. Next is significant adverse changes affecting the asset, such as plans to discontinue or restructure certain activities. Next could be internal reporting systems showing or predicting worse than expected performance from particular asset or business unit. So this means that internal reporting means every company generally prepare MIS through which they do reporting to the management. So if as per that internal reporting, it seems that the expected performance is going down, so then in that case also there is a situation that it is leading to impairment. Because generally, because on what basis that MIS is prepared, that MIS is basically states the expected performance of the company, and those expectations are based on previous year experiences. So suppose if I take an example that in the previous year we did sale of maybe 10,000 units, but in the current year when we are making that MIS, we have created a budget that we want to that the target that we have set for us for current year is 8,000 units. So that means the company has itself reduced its expected performance from 10,000 units to 8,000 units. There could be various reasons. Maybe the demand for that product has gone down, or the management is expecting that something, or maybe some regulatory changes are going to come, or maybe there could be some other reasons because of which the management has shown a fall in the internal reporting system. Okay, so these three are the internal indicators which shows that if any of these three fulfill, so then yes, again we need to do the impairment testing. Let's take the example on this. Hood is a small airline. It owns Dash aircraft, which it purchased to service a contract for passenger flight to a small island. The rest of its business is long-haul freight shipping. It has been informed that its license to operate the passenger service will not be renewed after the end of this current contract, which finishes in 6 months' time. It is proposing to use the aircraft in new business venture offering pleasure flights. So that means it is saying that it has 8 aircraft which it used which were getting used as a passenger flight to a small island. Now, there could be a situation that that license to operate at that small island might not be renewed, and the remaining tenure of that license is just 6 months. So in that case, what will happen is we are not going to earn any revenue from that aircraft after 6 months. So if the current carrying value of that aircraft is maybe 10 lakh rupees, and we know that we are not going to earn any cash flow from that aircraft after 6 months. So that means we need to impair that asset. And what we need to, how we will impair? We will first calculate the cash flow that we are going to earn in next 6 months, and we will reduce that from your carrying amount, and then we will see what is going to be our impairment loss. So it says the change in the use of the asset that is expected to take place in the near future is an indication that the aircraft may be impaired. Hood should make a formal estimate of the recoverable amount of its -8 airport. So we need to assess the recoverable amount so that we can estimate the impairment loss. Moving on to the next concept, as I mentioned earlier, like here I mentioned that when we were discussing the definitions, here I mentioned that we will discuss what do we mean by fair value less cost of disposal. So now let us understand what do we mean by fair value less cost of disposal. Yes, so fair value is determined under section 113. We will discuss there how to calculate Ind AS 113, how to calculate the fair value under 113, but I'll give you a gist of what 113 states. So 113 basically says that if there is any asset and there is a liability, so the fair value will be, in case of an asset, it would be the exit price. Exit price means that if you will sell that asset, what is the amount that you are going to realize from that asset? That is the amount that you will have to pay if you, the amount that you will be getting when you will be selling that asset. So that is called as your exit price. Now coming on to the liability. So if you have a liability, what will be the fair value of that liability? The fair value will be the amount that you will be transferring to take over that liability. Okay, so suppose if there is any asset, if you are going to sell that asset in the market, you know that you have a seller who will buy this asset at maybe 100 rupees. So that means in that case, the fair value of that asset as on today would be your 100 rupees. Similarly, if you have a liability, and if you are going to transfer that liability to somebody else, and you know that that liability will be transferred at 100 rupees. So that means the fair value of that liability would be 100 rupees. But we will discuss the concept of fair value more in detail in standard 113. Now coming on to the cost of disposal. The cost of disposal are direct incremental costs to bring an asset into the condition for its sale. What all are the examples of the cost of disposal? Legal cost, stamp duty or other taxes, cost of removing the asset, and any direct incremental cost of getting the asset into saleable condition. So these are the costs which are considered as cost of disposal and are excluded while calculating your recoverable amount. Right? So it says fair value less cost of disposal. So that means you need to first of all calculate the fair value, less you need to subtract the cost of disposal. So let us understand this with the help of an example. So we have an example, that is the fair value of an asset is $10,000. The other costs are cost of removing the asset $2,000, termination benefit $2,500, legal fees $1,000, documentary stamp papers $500, reorganization cost $1,500. What is the fair value less cost to sell the cash generating unit? So like if you go back to the cost of disposal, it says legal cost, stamp duty and other transaction costs. So here we have your cost of removing the asset, that is 2,500, legal cost $1,000, termination benefits 2,500. So what would be your fair value less cash to sell would be the total cost of disposal is $3,500. Reorganizational costs are not considered direct incremental cost of disposal of an asset. So that means what all cost we have considered: cost of removing the asset $2,000, legal fees $1,000, and documentary stamp papers $500. Termination benefits, for sure, we are not going to consider. Reorganization cost, we are not going to consider. So this is how we calculate our fair value less cost to sell the asset. Now moving on to the next concept, that is your value in use. What do we mean by value in use? So value in use is basically the present value of estimated future cash flows, future net cash flows. That means inflows less the outflows. I'm repeating again, value in use is the present value of estimated future net cash flows to be derived from continuing use of the asset and from its ultimate disposal. So that means what you need to do to calculate the estimated future net cash flows, you need to calculate what is going to be my inflows for next few years and what is going to be my outflows for next few years. And then you need to calculate the value in use. So what all elements will be considered while calculating the value in use? Cash inflows and the outflows specific to the asset. So that means cash inflows less the cash outflows will give you the net cash inflows. The time value of money, because you need to calculate the present value of those cash flows. Uncertainty inherent to that asset. Expectations about possible variation in the asset or the timing of those cash flows. Because you need to calculate, suppose if as on today, the useful life of that asset is left maybe 8 years. So you need to calculate the cash flows for next 5 years and you need to do the present value of those cash flows pertaining to those 8 years. Now it says for determining the cash flows, the company can consider the budgets and forecast for the period. Now the question comes, how we will calculate the inflows less the cash flows? How we will calculate the cash flows, that is the inflows less the outflows. So for that, Ind AS 36 says that for this purpose, the company can use the budgets and the forecast for the period not exceeding 5 years. Suppose you have a plant and we all know that as per the Companies Act, the useful life of that plant is 30 years. But now we know that we have to do impairment testing and we have to impair that plant and we need to calculate the value in use. So as of today, the useful life of that plant which is remaining is 15 years. Okay. So if the useful life that is remaining is 15 years, so 5 years we can always take from the budgets and the forecast. But the for the period over and above those 5 years, how we need to calculate the cash flows? The standard says we need to extrapolate that those budgets and your budgets and forecast using your steady and declining growth rate. That means we cannot take the increasing trend. We can either take your steady growth rate or we can take the declining growth rate, but we cannot take the increasing growth rate. Why? Because on the one side, we are saying that we are going to impair that asset. On the other side, we want to take the increasing trend. Both the things are not possible. Okay. Just a second. Okay. So any questions on value in use or any questions so far? Okay. If no question, then moving ahead to the next slide. Yes, it says how we need to determine the value in use. We need to apply an appropriate discount rate to those future cash flows. And how are we going? What is the rate that we are going to apply? We are going to apply a pre-tax discount rate, and which represents the market assessment of time value of money. If the future cash flows are risk adjusted, then the discount rate should be pre-tax risk-free rate. So what can be the pre-tax? Yes?
The screen is not visible.
Screen is not visible.
Presentation is not visible.
Since when it is not visible?
Just now, after you have put on hold.
Is it visible now?
Yes, ma'am.
Okay. So when we discussed value in, now I was just moving to your how to determine the value in use. So for determining the value in use, in the last slide, we discussed that we need to take your time value of money. That means we need to take one discount rate basis which we will be able to discount this cash flow, the net cash flows. So what is the discount rate that we can take? Discount rate can be a pre-tax discount rate which represents the market assessment of time value of money. However, if the future cash flows are risk adjusted, that means then the discount rate should be pre-tax risk-free rate. So maybe if I can give you an example of risk-free rate could be the rate at which you can do your FD in with the SBI. So because SBI FD rate is considered as the most secure rate, and it is considered as the risk-free rate as well. So we generally take this assumption that suppose if you have some idle funds lying with you and you want to make an investment, what would be the risk-free investment for you? The risk-free investment for you would be the FD. So generally, if a company does not have any risk-free rate, what we do, we generally go and take the SBI fixed deposit rate. However, if that is also not possible, it says that weighted average cost of capital can be used as a starting point. However, the rate does not depend on the entity's existing capital structure, as the cash flow from the assets are independent of this factor. So that means either you can take working capital cost of capital or weighted average cost of capital, or you can take maybe the incremental borrowing rate also. That also you can consider. So the standard has given you options, what all discount rates you can consider. Okay, coming on to the next very important aspect, allocation of goodwill. Allocation of goodwill means that in the books of accounts of a company, we already have a goodwill that is existing in the books of accounts. So how we will allocate that goodwill? That goodwill should be allocated on a reasonable and consistent basis to the individual assets or the group of assets. So that means if you are impairing any goodwill, how you need to impair that goodwill? Because like if I take an example on goodwill, let me understand the concept. Why do we need to impair goodwill and how we do the impairment of goodwill? So the concept that we have seen is how impairment loss is calculated. Impairment loss is calculated, that is carrying value less recoverable amount. But in case of your goodwill, it is not possible for us to calculate the carrying value, because how we will estimate? Either the carrying value can be the value that is already there in the books. But if we talk about the recoverable amount, is it actually possible for us to calculate the recoverable value of an asset, of a goodwill? No, it is not possible for us to calculate the recoverable amount of goodwill. So what does the standard says? That how your goodwill will be impaired, that we will see. So it says yes, it says that goodwill will be allocated on a reasonable and consistent basis to the individual assets or the group of assets. So that means if you have to impair the goodwill, it is not possible for us to calculate the recoverable amount. That is, it is not possible for us to calculate the net selling price, and it is not possible for us to calculate the value in use. So how we will impair the goodwill? We will impair the goodwill by allocating the goodwill to an individual asset or to a group of asset on a reasonable and the consistent basis. What could be that reasonable and consistent basis? This should be done at the lowest level at which the goodwill is monitored internally. How we can, what we can say is monitored internally, which must not be larger than the operating segments before an aggregation of reporting segments. So that means the level at which you are reporting your segments in the financial assets, in the financial books, at that level, you will allocate your goodwill into different individual assets or the group of assets. Like if I take an example, what could be the operating segments in your financial books? The operating segments could be, first of all, suppose if you are operating in different geographical locations, maybe you can say that I am operating in India, I am operating in US, I am operating in UK. Now, under those locations, you can say that in India, I am operating in South, North, and Central. Now, under that, you are operating in South, maybe you are operating in Tamil Nadu, you are operating in Andhra, you are operating in Karnataka. So, at which level you are showing your operating segments? So, here in this case, what are your operating segments? Your operating segments are Tamil Nadu, Andhra Pradesh, and Karnataka. So that means you need to do the bifurcation of your goodwill into this different individual assets or the group of assets to the level that you are showing your operating segments in the books of accounts. At that level, you need to do the allocation of your goodwill. And this is how the impairment of your goodwill will happen. Now moving on to the impairment loss accounting for cash generating units. So here we are not talking about just impairment loss. We are talking about impairment loss accounting. So that means how your entry for impairment loss will be made. First, the impairment loss should be allocated to any goodwill allocated to the unit. So that means if you have an impairment loss, that should be first allocated to any goodwill allocated to the unit. Next, it should be applied in pro rata basis against the other assets in the unit, but not so as to written down any value below the highest of. That means your fair value less the cost of asset if measurable, its value in use if determinable, or zero. So that means you cannot make the carrying value of asset as negative. You can either make it zero or you can make it positive, but you cannot make it negative. Loss for a cash generating unit ever be included as a liability only if other standard requires it, and the liability will be measured according to that specific standard. Let us understand this with the help of an example. The carrying value of an entity's J's cash generating units is 1000 rupees. And the recoverable amount, that is higher of its fair value less cost to sell, and the value in use is 900. So that means what we are saying is that the carrying value is 1000, but the recoverable amount is only 900. So this is a clear-cut case that we need to recognize the impairment loss of 100 rupees. The goodwill allocated to the cash generating unit is 50 rupees. The other assets in the cash generating unit comprise plant and machinery and the technical know-how, which has the carrying value of 500 and 450 respectively. So how we need to account for the impairment loss in this case? The total impairment loss for the CGU is your 100 rupees, as we discussed, 1000 minus 900. Entity J should first allocate the impairment loss against goodwill, as we discussed over here. First, the impairment loss should be allocated to any goodwill allocated to the unit. So that means now when we have your impairment loss of 100, this should be first allocated to your goodwill of 50. The remaining 50 shall be divided into your machinery and technical know-how in the ratio of 500 to 500 and 450. So this is what it says. Entity J should first allocate the impairment loss against the goodwill allocated to the impaired CGU for 50 rupees. The balance 50 rupees loss should be allocated on pro rata basis between the plant and machinery based on their carrying value, that is at 26 and 24 rupees. So this is how you will divide your 100 rupees impairment loss. How you divided your 100 rupees impairment loss? You have divided 50 rupees to the goodwill and balance 50 rupees you have divided to plant and machinery and to your know-how in the ratio of the carrying value of 500 and 450. So this is how we allocate, and this is what was mentioned on our previous slide. It says first the impairment loss should be allocated to any goodwill allocated to the unit, and the balance should be allocated to the other assets. Moving on to the next concept, that is impairment loss accounting for individual asset. If the carrying amount of an asset exceeds its recoverable amount, the carrying amount should be written down to the recoverable amount. We have already discussed it in our multiple slides. The impairment loss is immediately expensed in the income statement unless the asset is carried at revalued amount in accordance with your another standard. So that means, let's first understand if the revaluation never happened in the past, then what will be the accounting entry? The accounting entry will be simple impairment loss account debit to the asset. Okay, this will be the simple entry. Now let's add some twist to it. And the twist is that in the past, the asset has been revalued. So how the accounting should be done? So the standard says, when the asset is carried at a revalued amount, the impairment is accounted as a decrease of the revaluation surplus. This means that the loss is charged first against the amount of any existing revaluation surplus on the asset and only thereafter to the income statement. So that means if there is any asset which has been revalued in the past, you need to first hit that revaluation reserve and then only the balance will be taken to your P&L. However, if an asset has not been revalued in the past, then the direct hit will go to your P&L, that is your income statement. What is the entry that will happen if you have a revaluation reserve in the past? Then the entry would be revaluation reserve account debit to asset, and the balance, suppose you have to do the impairment of maybe 150 rupees. But in your revaluation reserve, you have only 50 rupees. So that means 50 rupees will go to revaluation reserve to asset, and balance 100 rupees will go to impairment loss account debit to asset. So this is how it will be. So it says next one is reversal of impairment loss. Reversal of impairment loss is applicable only for the case where the asset has been impaired earlier. So now we say that earlier the impairment has happened, but now due to some situations, we started using the same asset and now we see that the recoverable amount is even higher than the carrying amount. So if recoverable amount is higher than the carrying amount, then we do not need to impair the asset. So what we need to do is we need to reverse the impairment loss. And up to what extent the recoverable loss will be reversed? The reversal shall be to the extent of lower of recoverable amount less the carrying value. Next is carrying value of an asset as if such impairment was not recognized earlier, less the carrying value of an asset as of today. So you need to calculate the lower of these two, and that up to that amount, the reversal will happen. That means you need to increase the value of an asset up to this extent. Now coming on to the next slide, frequency of impairment. Assets must be tested for impairment whenever there is any indication of impairment exists. However, the following assets need impairment testing at least annually. What all assets? Cash generating units to which goodwill has been allocated, intangible assets with indefinite useful life, intangible assets which does not have the available, intangible assets which are not yet available for use, like software which is still under development. Now there are few disclosures also. like we need to give disclosure for your impairment loss. By each class of asset, we need to disclose the amount of impairment loss recognized oblique reversed during the period in the statement of P&L, amount of impairment loss oblique reversals on revalued asset recognized in other comprehensive income during the period. If recognized in P&L, disclosure of where that item is included, that also needs to be given separately. Segment reporting information, events or circumstances leading to impairment, disclosure where impairment losses are material for an individual asset. By each class of asset, we need to give the disclosure, that is information on basis used for determining the recoverable amount, discount rate used, estimates used to measure recoverable amount of CGU containing goodwill impairment asset with definite useful life, allocate your goodwill, unallocated goodwill if any, along with the reason. So these are the disclosures that you need to give with respect to your impairment loss. So this is it from my side in terms of your impairment loss, that is Ind AS 36. If you have any questions, please feel free to ask your questions. I will be sharing these slides with the registered valuer staff, the team that is sitting out there, and they will be sharing these slides with you. Any questions so far? Okay, now moving ahead to the next standard. We will take the next standard as 113 because in this standard 36 we discussed about fair valuation. So let us understand what do we mean and how your fair valuation is being calculated. I'm going to share my screen. Please let me know if my screen is visible. Is my screen visible? Okay, so let us start with Ind AS 113, which talks about the fair valuation. So in this standard of 113, what all we are going to discuss? We are going to first of all discuss the applicability. That is on what all things the Ind AS 113 is applicable. So Ind AS 113 is applicable when another standard talks about Ind AS requirements or permits fair value measurement. So that means Ind AS 113 will not tell you when to calculate the fair value. Ind AS 113 will only tell you how to calculate the fair value. Because when to calculate the fair value will be recommended by the other accounting standards. Then what all will be the disclosures that are required for fair value measurement? Ind AS 113 excludes 102, that is share-based payment, 116, that is leases, Ind AS 2, that is inventory, 36, that is impairment. Now moving on to what is the definition of your fair value. So guys, on this 113, you will be getting various theoretical questions. And I think there will not be any practical question. There will be the theoretical questions. So that is why we need to understand the concept of fair value. So what is the concept of fair value? We need to calculate the fair value of an asset and a liability. So what is the fair value of an asset? As we discussed, the price that would be received to sell that asset. That means the exit price. It says fair value is an exit price. In case of an asset, what is the exit price? The price that would be received to sell the asset. In case of a liability, the price that would be paid to transfer the liability. In what all transactions? In an orderly transaction between the market participants and at the measurement date. What do we mean by market participants? Market participants are basically the participants where we have a buyer, a seller, they should not be the related party, and they should have the knowledge in which transaction they are entering into, plus they should have the reasonable mindset to enter into that transaction. So that means they are the participants who are actually willing to enter into such kind of transaction. So that is why it is called as the fair value is the price that would be received to sell the asset in an orderly transaction between the market participants and at the measurement date. What do we mean by a liability? Fair value of a liability, the price that would be paid to transfer the liability in an orderly transaction between the market participants and at a measurement date. As I mentioned, Ind AS 113 will not prescribe when to measure the fair value. However, it will let you know, or it will provide you the guidance on how to measure the fair value. That is when it is required or permitted by the specific Ind AS. So that means other Ind AS will tell you when you have to calculate the fair value, and Ind AS 113 will tell you how to calculate the fair value. While calculating the fair value, we need to exclude our transaction cost. So that means the fair value will be the exit price less the transaction cost. Now let us understand the various concepts about your Ind AS 113. Basis these concepts, you will get some questions in your registered valuer examination. Those would be more or less the theoretical questions. Like, first of all, for active market, what do we mean by an active market? A market in which transactions for the asset or liability take place with sufficient frequency and volume to provide pricing information on an ongoing basis. So that means active market is a market where a certain asset or a liability has been traded with sufficient frequency. Sufficient frequency means not just once, that asset or the liability has not been traded just once or twice, but that asset or liability is getting traded on sufficient frequency, maybe 100 times in a month or 200 times in a month, and with sufficient frequency and volume. If that is the case, then yes, it will be considered as an active market, and it will provide you the pricing information for that asset. Entry price, the price paid to acquire an asset or received to assume a liability in an exchange transaction. What do we mean by exit price? The price that would be received to sell an asset or paid to transfer a liability. So that means entry price is from the perspective of the person who is acquiring the asset, or who is who is discharging the liability. But if you talk about the exit price is from the perspective of a person who is selling the asset, and from the perspective of a person who is assuming the liability. What do we mean by a principal market? Principal market is the market with the greatest volume and the level of activity for the asset. So that means here we have the difference between your active market and principal market. Active market means where your asset or liability is traded with sufficient frequency and volume. But principal market is the market where your asset is being traded with greatest volume and the level of activity. Like if I take an example of your share market, we have NSE, we have BSE. So what do you think? Which market will have the greatest volume and the level of activity? That would be NSE. Okay. Now coming on to what do we mean by market participants? As I mentioned when we were discussing this definition, what did I mention over here? What do we mean by market participants? Market participants are basically the buyers and the sellers in the principal market for the asset or the liability that have all the following characteristics. What all characteristics? That they are independent of each other. That means that buyer and seller should not be related to each other, because if they will be related, the price will not be an arm's length price. They should be knowledgeable of what they are buying. They are able to enter into a transaction for the asset or the liability. So that means the buyer and seller should not be related, because if they will be related, the price will not be the arm's length price. They should be knowledgeable of what kind of transaction they are entering into. Then the next thing is they are able to enter into the transaction. That means they have that willingness to enter into the transaction. What do we mean by most advantageous market? The market that maximizes the amount that would be received to sell the asset or minimizes the amount that would be required to transfer the liability after taking into account transaction cost and transport cost. So most advantageous market is the market from where it is a market where if you will sell your asset, you will get the maximum amount while selling the asset. And if you transfer your liability, you need to pay the minimum amount to transfer the liability after taking into account your transaction cost and transportation cost. What do we mean by highest and best use? The use of non-financial asset by the market participant that would maximize the use of an asset or the group of assets or liability within which the asset would be used. Now let us understand with the help of an example. Transaction cost and transportation cost. When we are measuring the fair value, we are not going to consider the transaction cost, but we have to consider the transportation cost. When we are determining the most advantageous market, we have to consider the transaction cost and the transportation cost both. Now let us understand with the help of this example. You have there are three markets: market A, market B, market C. Annual volume in market A is 30,000. In market B, it's 12,000. In market C, it's 6,000. Transactions per month is 30, 12, and 10. Price is 50, 48, and 53. Transportation cost is 3, 3, and 4. Quoted value is 47, 45, and 49. Transaction cost is 1, 2, and 1. Net proceeds that you are getting is 46, 43, and 48. Now let us see how we will determine the fair value. If we will see who is our principal market. What did it say for the principal market? The market with the greatest volume and the level of activity. So that means if we have three markets, which market has the greatest volume? The volume that we have is the market A. So here it says principal market is the greatest volume and the level of activity, market A. And what will be the fair value? The fair value will be your 47 because we are not going to consider the transaction cost. So we need to take this quoted value into consideration. Most advantageous market. Most advantageous market is the market that maximizes the amount that you would be received to sell the asset. What is the market in that case? Market C, because your net proceeds is maximum in this case. And in case of most advantageous market, you need to calculate, you need to take into consideration your transaction cost and transportation cost both. So that means most advantageous market is the maximum value of an asset. That is market C, and where the fair value will be your 49. That is the quoted value, 49 rupees. So this is how basically we calculate. We basically first of all understand which is our principal market, which is our active market, which is our entry price, which is our exit price, which is our most advantageous market, and basis this we calculate the fair value. So this is what the concept of this fair valuation under 113. Now coming on to the valuation techniques. We have three types of valuation techniques. First one is the market approach, second one is the cost approach, and the third one is the income approach. Let us understand what do we mean by a market approach. Market approach is a valuation technique that uses prices and other relevant information generated by market transactions involving identical or comparable assets, group liabilities, or group of assets and liabilities. So that means under market approach, you need to take into consideration the price that is being generated by the market transactions. Different techniques that are there are, first of all, market price technique. You can directly take the market price. You can take comparable companies multiple. Comparable companies means two companies which are in the same business and they should be comparable also. Like if there is a telecom company, they should be, first of all, both the companies should be related to telecom sector. Secondly, they should operate in the same location. Like they should, if we are talking about Delhi, then they should operate within Delhi only. So then only we can say that their market price would be comparable. Comparable transaction multiple, that means now we have seen that there are two companies which are pertaining to telecom sector. Now after telecom, they should be in same location, and after that they should have same level of transaction, same quantity of transactions. When do we use market approach? This is often used for equity securities which have quoted price in the exchange market. Real estate, when comparable transaction and prices are available. Investment opportunities, investment properties, and land and building. Coming on to the next, that is cost approach. Cost approach is also referred to as current replacement cost. That means, suppose if you have an asset and you have to replace that asset. So what is the price that you will have to pay to replace that asset? That will be considered as your current replacement cost. A valuation technique that reflects the amount that would be required to replace the asset, replace the service quantity of an asset. Typically used to determine the valuation of tangible asset. As I mentioned earlier also, suppose there is an asset and you have a spare part of that asset. You want to replace that spare part. So what will be the replacement cost? The price that you will pay to replace that spare part will be called as your current replacement cost. For example, if company A has to determine fair value of its factory machinery using this approach, fair value would be the cost that would be incurred by company A to replace the machinery on the date of valuation. Moving on to the income approach, valuation techniques that convert future amounts to a single current amount. That means your cash flows or income and expenses. So valuation technique is the technique that basically convert your future amounts. What are your future amounts? Your future cash flows, your future income and expenses to a single current amount. That means you need to do the present value. So you have your cash flows of next 5 years. Now, if you calculate the present value of that cash flow, that is basically called as your single current amount. The income approach is applied using the discounted cash flow technique, which requires estimating future cash flows for a certain discrete projection period. Like in case of our Ind AS 36, we said that we will take the discounted cash flows for 5 years. That is the budget for 5 years. And if it's beyond 5 years, we need to extrapolate that amount. Estimating the terminal value, discounting those amounts to present value at a rate of return that considers the relative risk of the cash flow and the time value of money. Typically, this income approach is used to measure value of businesses, financial instruments, liabilities, and intangible assets. Now coming on to the disclosure. For your fair value, the disclosures have been significantly increased. First one is when you are giving the disclosure, you need to show the disclosure of level 1, level 2, and level 3 markets. What you need to show in this, you need to show the quoted price, that is unadjusted price in the active markets for identical assets and liabilities that the entity can assess at the measurement date. Quoted price should be used without any adjustment. So that means you need to show the quoted price. What could be the quoted price? Suppose if you have an equity share, they are listed on a particular stock exchange. So then it will be called as your quoted price. So price of a financial asset or a financial liability for identical assets or liability traded stock exchange like Bombay Stock Exchange. Level 2 would be inputs other than the quoted price that are observable for the assets or liabilities. Quoted, that means examples are quoted price for similar assets or liabilities in the active markets. Other inputs could be interest rate and yield curves observable at commonly quoted intervals, LIBOR swap rate, bank prime rate. Level 3 would be unobservable inputs for the asset or liability. So that means you need to show 3 types of inputs. First of all is your quoted price, second is your observable price, and third is your unobservable price. What do we mean by unobservable price? Unobservable price is basically your projected cash flows used in a discounted cash flow calculation. So this is how you need to give the disclosure of level 1, level 2, and level 3. Next disclosure that we have to give under 113 is the fair value disclosure of various financial assets and the financial liability. So to explain this, I have taken this disclosure from the financial statements of one of the company. So here they have first of all shown the carrying value of an asset, and they have shown the fair value of an asset. So against each financial asset, you have to show the fair value of an asset as well. So this is how the disclosure is there. Disclosure comes into picture when you have to give the fair value of a specific asset. So as per 113, you need to give the fair value. You need to disclose the fair value of all the financial assets and the financial liability corresponding to the carrying value of an asset or a liability. So this is how the disclosure will be, that at one side your carrying value will come and on the other side your fair value will come. Understood? Any question? Okay. So shall we move to the next standard, or you guys would like to take just quick 5 minutes break? Shall we continue? Okay. Okay, people are saying 5 minutes break. Okay, you can take 5 minutes break, and the time is almost 10:45. So let us meet by 10:50. Okay. Yes, now moving on to the next topic. I hope everyone is back. So now let us start with Ind AS 103, which is your business combination. And after that, we'll come on to the last standard, which is your financial instruments. I'm sharing my screen again. Yes. So let us start with Ind AS 103, that is business combination. So in this standard, we will first of all understand what is business combination, what all things we need to identify or what all things we need to check while identifying whether there is a business combination or not, or it's a asset acquisition, how the accounting for business combination needs to be done, how the goodwill is to be accounted for, how the capital reserve or the pooling of interest method needs to be taken care of. So all these things we will take care in your Ind AS 103. So Ind AS 103 is applicable on all these transactions. So Ind AS 103 applies to our transactions or other events that meets the definition of a business combination. So what all transaction meets the definition of a business combination, that we will study in our upcoming slides. Then combination of entities or business under a common control. What do we mean by common control? That also we will study in our upcoming slides. There are few things which are scoped out, like formation of joint ventures are scoped out because they are taken, joint ventures are taken care in your separate accounting standard. And asset acquisition will not be covered over here because asset acquisition will be taken care in your PPE standard. Now coming on to, we need to identify what is a business combination. So for identifying the business combination, we need to check certain things. First of all, the business that we are acquiring, we need to first of all understand whether there is a business or not. So what does it say? What is business? The business is an integrated set of activities and assets which are capable of being conducted and managed to provide returns. Returns could include your dividend and cost saving. So it is saying integrated set of activities. What do we mean by integrated set of activities? So that means every business should have an input, should have a process, and should have an output. Out of these three, input and process is required to be there mandatorily. If output is not there, then also it's fine, but input and process should be there. If input and process are not there, then it will not be considered as your business combination because there is no business. It will be called as your asset acquisition. However, if input and process is there, then yes, it can be called as your business combination. How we need to take care of business combination? So business combination is a transaction or an event in which the acquirer obtains the control over one or more businesses. What do we mean by control? Control is basically defined under your standard IFRS 10 Ind AS 110. So what do we mean by control? Control is basically the power over the investee or the exposure or rights to variable returns, ability to use its power over the investee to affect the amount of investor return. So that means you have the power over the investee. What kind of power could be there? Maybe the power to control the operations of the company, the power to appoint any KMP on the company, then exposure or rights for variable returns. You have the rights to the returns from the company. You have the ability to use its power over the investee to affect the amount of investors' return. So that means first step, what we need to check is whether there is a business or not. Then the next step is we need to check for a business combination that there should be a control or not. Whether the control is there or not. What do we mean by control is where we have these things in picture. Now let us understand but only inputs and processes are mandatorily required. As I mentioned, input could be your anything. It could be an employee, it could be the raw material, it could be any asset. Process could be your strategic or process, operational process, it could be a manufacturing process, or it could be anything else as well. Outputs are not mandatorily required for a set of activities and assets to qualify in a business. Development stage activities without output may still be business. So that means input and processes we need compulsorily, but output is not mandatorily required. Let us understand this with the help of few examples. We have Biotech A, which acquires outstanding shares in Biotech B, a startup with license for a product candidate. Due to the loss of funding, Biotech B has no employees and no other assets. So that means if we see over here, whether there is any input, no, there is no employee or there is no other asset. Neither clinical trials nor development are currently performed. However, Biotech A will commence phase A clinical trials. So now, what is the situation? We do not have any asset, we do not have any employee. What we have is only the shares and the license. So should the acquisition be accounted for as a business combination or an asset combination? It says that it is not a business. Why? Because we only have one input, that is the license. There is no process, there is no output. Next is, if we change the scenario, Biotech A acquires outstanding shares in Biotech B, a startup with license for a product candidate. Phase 1 clinical trials are currently performed by 3 Biotech B employees. So that means now we have the input also, but we do not have the output yet. We have a process also, one of whom finded Biotech B and discovers the product candidate. So should the acquisition be accounted for as a business combination or an asset acquisition? Here it will be accounted for as a business. Why? Because we have the license and the employees. It says we have a startup license and we have the employees who have performed the clinical trials. Process, yes, we have operational and management process associated with the performance and supervision of technical tests, because here we have done the technical test as well, but there is no output. For output, we have already discussed that it is not mandatory to have the output. Next one is application in real estate industry. Company A acquires land and a vacant building from company B. No processes, other assets or employees are there. So it is a clear-cut case of a asset acquisition, because company A has acquired company B from the perspective of acquiring the building, because there is no input, no process and no output. Next, if we change the scenario a bit, company A acquires an operating hotel. Now we have the operating hotel. Operating hotel means we must be having some input, we must be having some processes and the output all. The hotel employs the franchisee. The hotel employs the franchisee agreement, inventory, reservation system, and all back office operations are there. So that means it is a clear-cut example that yes, it is a business. So that means when you are doing business combination, you need to first identify whether we have a business or not. If yes, it is a business, then we need to go for whether control is there or not. Now coming on to what is the difference in accounting for business combination versus the asset acquisition. So in the business combination, your goodwill will come, because when you do the business combination, how the accounting of business combination is being done, you will be paying certain consideration, that is the purchase consideration, and in exchange of that purchase consideration, you will be getting certain assets and the liabilities. So the difference of your net assets and the purchase consideration could be your goodwill, or it could be your bargain purchase gain also, that is your capital reserve. But in asset acquisition, no goodwill is being recognized, your profit and loss is being recognized. Initial measurement of assets acquired and liabilities assumed are at fair value. In asset acquisition, purchase consideration is allocated to the fair value of the assets. Directory attributable transaction cost, it is expensed. We need to take it directly to the P&L and expenses of under business combination, but in asset acquisition, we need to capitalize it. Deferred tax on initial recognition is recognized in business combination, but it is not recognized under your asset acquisition. Disclosures are more extensive in your business combination, but in your asset acquisition, there are less disclosures required. Let us understand it with the help of this example, the concept that we have studied over here. So it says, entity P acquires 100% of entities B share for 1000 rupees, incurring the transaction cost of 200 rupees. For the transaction cost, it says that it needs to be directly expensed off. Here it needs to be capitalized. V has no liability. The only assets are two buildings, A and B. Their book value is 700. The fair value of A and B is 300 and 600 respectively. Tax base of buildings is 700 and income tax rate is 20%. So that means the price that you are paying, that is the consideration you are paying, is 1000 rupees, 1000 rupees. Transaction cost under business combination is expensed off. Under asset acquisition, it is capitalized. Total consideration would be 1000 rupees. And here, since you are capitalizing it, your total consideration would be 1200 rupees. So how the fair value will be divided? It says here, it was mentioned that initial measurement of assets acquired and liabilities assumed will be at fair value. Here under asset acquisition, purchase consideration is allocated to the fair value of the asset. So let's see how this will be done. So asset A and asset B, the fair value is 300 and 600. So that means we have paid 1000 rupees. Fair value we have got for 900 rupees, and the balance 200 will go for your deferred tax liability and your goodwill portion. However, over here, we need to allocate this 1200 into your, what does this standard say for the asset acquisition? It says purchase consideration is allocated to the fair value of the assets. So that means it says that your purchase consideration, that is 1200, to be allocated in the ratio of your 300 and 600. So which comes out as 400 and 800. So in this case of asset acquisition, there will not be any detail and there will not be any goodwill as well. So this is how this business combination accounting will be done. That we need to take into consideration the fair value of the assets. We need to compare it with your purchase consideration. The difference would be accounted for as your goodwill or your bargain purchase gain. But under your asset acquisition method, there is no goodwill or bargain purchase gain. We need to directly divide the consideration that we are paying into the fair value. We have to divide that into the ratio of the fair value of the assets and the liabilities that you are acquiring. There will not be any goodwill or the bargain purchase gain. Moving on to the next slide, let us understand the acquisition account method of accounting. For acquisition method of accounting, we need to understand few concepts, that is, who is the acquirer, what is the acquisition date, identifiable assets, liabilities assumed, and your NCI, that is your, and the consideration transferred, goodwill or bargain purchase. So let us understand who is our acquirer. For each business combination, one of the combining entities shall be identified as the acquirer. The entity that obtains the control of the acquirer is identified as the acquirer in all business combinations. So that means you need to identify which party is taking the control. That party will be considered as your acquirer. So by the control, what can be the case? That party has more than 50% voting right. That party has power to appoint the board of directors. That party has, that investor has potential voting rights. That party can, that party can, that party has the right to hold any kind of decision or to make any kind of big decision in the company. So basis all these things, we can say that yes, the acquirer will be the person who is holding the control in the acquiry. That person will be called as your acquirer. So IFRS 10 guidance on control for identification of the acquirer says, if applying the guidance in 113 does not clearly indicate the acquirer, the following factors are considered in making the determination. Acquirer is usually the entity that transferred the cash or the other assets. Acquirer is usually the entity that issues its equity interest. That means they are issuing the equity shares. Acquirer normally has the largest portion of its voting rights in the combined entity. Acquirer will have the ability or elect or appoint or remove the majority of the members of the governing body. As I mentioned, has the power to appoint the board of directors. Now let us understand this with the help of an example where a new entity, new company is formed to affect the business combination between two or more entities, say B and C. So B and C have formed a new company, that is new company. Ind AS 103 identifies two different scenarios. First of all, new company issues its equity shares in exchange for equity instrument in B and C. Either B and C should be identified as the acquirer basis the percentage of the shares that they have got for new company. Next is new company transfers cash in exchange for the equity instrument in B and C. Example, from the proceeds of debt or equity issue to new investors. So in this case, because new company is transferring the cash in exchange of the equity instrument, so new company must be identified as the acquirer of B and C. Now let us understand with the help of a next example. X and Y are two existing entities carrying on business independently. The two entities decide to combine their businesses through a new entity Z. New entity Z issues equity shares in itself in the proportion of 2/3 to the equity shareholders of X and 1/3 to the equity shareholders of Y. So in this case, who is the acquirer of Z? Can anyone tell me who is the acquirer? Any idea? Who is the acquirer of Z? Okay. In this case, the acquirer of Z would be X company. Why? Because the X company is holding 2/3 of the shares of Z. Y company is only holding 1/3. So if you have heard about your subsidiary accounting, so what does subsidiary accounting says? How a company becomes a subsidiary if any company is holding more than 50% shares of a company. So that means that company becomes the subsidiary company. So here X is holding more than 50% because X is holding 2/3 of the shares of Z. So that is why X need to consolidate Z as its subsidiary, and X is holding, or X is the acquirer of company Z. So this is how we need to check who is acquiring, who is the acquirer. Now coming on to the acquisition date. So acquisition date is basically the date on which it is effective. That means the date from which your date of filing of court order sanctioning the scheme. So the date from which your court order has sanctioned the acquisition, that date will be considered as your acquisition date. So generally the date on which the acquirer legally transfers the consideration, acquires the asset and assumes the liability of the acquiree will be normally the closing date. However, the acquirer might obtain control on a date that is either earlier or later than the closing date. The acquisition date precedes the closing date if a written agreement provides that the acquirer obtains control of the acquiree on a date before the closing date. Date on which control is acquired by the acquiree is the agreement subject to substantive precondition. The acquisition date will be the date the last of those precondition is satisfied. Date when acquirer commence direction of operations and financial policies. Date when majority of board of directors are appointed. Date from which the flow of economic benefits changes. The date of clearance by competition authority. So that means ultimately what will be the date of acquisition? The date of acquisition is the date the acquirer from the date from which the acquirer is obtaining the control. You need to check from when they are obtaining the control, and the date from which the control is assumed by the acquirer will be considered as the date of acquisition. Okay. Moving on to the next slide. Let us understand this with the help of an example. Company A has signed a purchase agreement PA with Company B on July 1. PA was filed with the High Court for approval on Jan 1, 2001. PA provides that subject to the High Court approval of the agreement, any profit and loss arising out of the operations of B from July 1, 2020 will belong to A. PA provides that management of B will run B from the July 1, 2020 as trustee of A. PA also provides that the purchase consideration payable by A to B will be based on B net value as net assets value as at 1st July 2020 and as determined by the independent valuer. The High Court approves the transaction on 25th March 2001 and is filed with ROC immediately. A is preparing the CFS for the year ended 31st March. So can anyone tell me which date will be considered as the acquisition date? Okay, so in this case, the acquisition date will be considered as 25th March 2001 because this is the date on which High Court has approved that yes, from this date, this is the date on which High Court has approved the transaction. Now let us understand the recognition of assets acquired, liability assumed, and the NCI, that is the non-controlling interest. Recognition and measurement at the acquisition date, the acquirer shall recognize separately from the goodwill, the identifiable assets that you have acquired, the liabilities that you have assumed, and any non-controlling interest in the acquiry. What do we mean by the non-controlling interest? So non-control, say if we take the example of a subsidiary. So in case of a subsidiary, if suppose you have acquired 80% stake in the subsidiary. So the balance 20% will go under your NCI. Because in case of a subsidiary, you need to do line by line consolidation, right? So that means you will do line by line consolidation and the portion of that 20% which you have not acquired will go to your non-controlling interest in the acquiry. Measurement will be done at the fair value at the acquisition date. For recognition of identifiable assets acquired / liabilities assumed as part of the acquisition method, these assets and liability must meet the definition of assets and liabilities in the framework, must be part of what the acquirer and acquiree exchange in business combination transaction. So that means as part of your business combination, recognition and measurement, what all things you need to see, that first of all, you need to see what is the percentage that you have acquired. That is, if you have acquired for more than 50%, you need to do line by line consolidation. And the balance, suppose if you have acquired 80%, balance 20% will go to NCI. But if you have acquired less than 50%, then it will go to your associate accounting. And what you need to do or how you need to do the accounting under associate accounting, you need to follow your your equity method. What do we mean by equity method? That is, in equity method, if you have acquired suppose 20% stake in your associate, so you just need to take into consideration the value for that 20%. You cannot do line by line consolidation when it comes to your associate. So in case of your associate, if you have bought 20% stake in that company, then you need to record your investment account debit to bank in your books of accounts for that 20% only. So first of all, we need to see that how much percentage we have acquired. Then we need to see what are the identifiable assets that we have acquired, what are the liabilities that we have assumed, and the balance should come to your non-controlling interest. And since under Ind AS, all the values that you have to take should be based on your fair value, so we need to measure the fair value of all the assets and the liability at the acquisition date. This is the same thing that we understood in this example also, the example that we saw. So we need to take into consideration the purchase consideration and the fair value of the assets and the liabilities that we have assumed. What do we mean by non-controlling interest? So the non-controlling interest is equity in a subsidiary not attributable directly or indirectly to the parent. So that means non-controlling interest is the leftover equity, are the leftover shareholders. So suppose out of 100% holding, 80% holding is with one company and rest 20% has been maybe segregated to various other stakeholders. So then that 20% will go to your non-controlling interest. So measurement of NCI at the acquisition date, we need to again measure this at the fair value. And how we need to do? We need to calculate the proportionate number of acquirees identifiable net assets. That specific portion will go to your NCI. Now coming on to how the goodwill is being calculated. Goodwill is basically, so when you pass your entry for your business combination, it can either be the goodwill or it can be the bargain purchase gain, depending on whether you have paid more and you have received less, or you have received more and you have paid less. So bargain purchase is one where goodwill is negative. So bargain purchase, if I take you back to the older days where we had your Indian GAAP, not the Ind AS. So bargain purchase is the another name for your capital reserve. Okay. In your old accounting standard, that is in your erstwhile accounting standard, we had the concept of goodwill and the capital reserve. But here in the Ind AS, we have the concept of your goodwill and the bargain purchase gain. So when you do not have the goodwill, you will get your bargain purchase gain. So that means your bargain purchase gain will come when you have paid less and you have received more. So then the balance will go to your bargain purchase gain. But when you have paid more and you have received less, then your goodwill will come into picture. So here it is saying a bargain purchase is one where the goodwill is negative. A bargain purchase might happen, for example, in a business combination, that is a forced sale in which the buyer is acting under compulsion. In such case, the acquirer should reassess whether it has correctly identified all the assets acquired and the liabilities assumed. If reassessment confirm bargain purchase, any gain is recognized in the equity as capital reserve. This is what I was talking. That in the old accounting standard, instead of bargain purchase, we used to call it as capital reserve. But in your Ind AS, we are calling it as bargain purchase gain, but they are directly recognized under equity as your capital reserve. So if you ask me how we are going to do the accounting or how this will be presented in your balance sheet, so it will directly go to your equity under your capital reserve. Let us understand the common control transactions. Common control, as I explained earlier also, common control means where the person is having the power to control the operations, power to appoint a board of director. So it says combination of entities or business in which all of the combining entities or businesses are ultimately controlled by the same party. So it says combination of entities or business in which all the combining entities or businesses are ultimately controlled by the same party, both before and after the transaction, and the control is not transitory. It will include transactions such as transfer of business or businesses between entities within a group, the extent of minority interest in which the combining entities before and after the business combination not relevant to determine. So basically, if I tell you in the nutshell, for the common control transaction, you need to make an assessment that whether the acquirer is getting the control over the company or not. And how the control is being established? The control is being established if that acquirer is obtaining the power over the board of directors, that is, has the power to appoint or remove anyone from the board of directors, has the power to take the decision with respect to any capital expenditure. So basically, any major decision, if any party is taking on behalf of the company, then you can clearly say that yes, that party has control over the company. Let us understand what do we mean by how do we apply the pooling of interest method. assets and liabilities of the combining entities are reflected at their carrying amount. So how your pooling of interest method will be applicable? That is, your assets and liabilities of the combining entities will be reflected at their carrying value. Only adjustments that are made are to harmonize the accounting policy. Then the next step, no new goodwill will be recognized. Financial information in the financial statement in respect of the prior period should be restated as if business combination has occurred from the beginning of previous period. However, if business combination has occurred after the date, prior period information shall be restated only after that date. With respect to the prior period business combination, I just want to tell you one more thing. Like suppose if we take an example that your business combination accounting Ind AS is applicable maybe from 1st April 2016. So now business combination accounting standard says that you need to restate all the prior business combination that has happened before 1st April 16, and you need to bring the restated value to the books of accounts. However, if you guys have idea about Ind AS 101, Ind AS 101 says, Ind AS 101 basically provide you certain exemptions also. So under Ind AS 101, you have been provided with an exemption that if an entity wants, the entity might not be required or might not restate the business combination that has happened before the first time adoption of the Ind AS. So generally, many companies take this exemption that we will not restate the business combinations that have happened before the 1st April 2016. So coming on to the disclosure requirements for your business combination, you need to give general information on the business combination. What is the business you have acquired? What is the consideration you have transferred? What is the assets you have acquired and the liabilities you have assumed? Gain, goodwill or gain on bargain purchase transactions that are not part of the business combination. If the acquirer holds less than 100% of the acquiry, because this will basically show if you are holding 100% or less than that, what is the accounting that you have done. If you are holding more than 50%, subsidiary account, if you are holding less than 50%, then associate accounting will come into picture. Business combination achieved in stages, pro forma information about revenue and profit and loss, and the measurement period adjustment and contingent consideration adjustment. Revenue and profit and loss of combining entity for current reporting period, as though acquisition date of for all business combination that occurred during the year has been as of beginning of annual reporting period. So that means as at the reporting period, whatever business combinations you have acquired, you need to show the revenue and the profit and loss of that combining entity. You need to do the reconciliation for the goodwill, that is opening amount of gross goodwill and the impairment losses, if any. Additional goodwill recognized in the current period, adjustment from recognition of DTA, movement in goodwill of a disposal group, impairment losses recognized in the period, net exchange differences arising, any other changes in the period, closing amount for gross goodwill and impairment losses. So this is how you need to show a walk of your goodwill, or I would say the reconciliation of your goodwill. So this is it in your business combination standard. If anyone have any questions, you can ask those questions.
What would be the scenario when a business combination happens where an acquirer acquires an LLP? How is it different then? I mean, because there the voting right should be different or the ownership right should be different. No? So what would be the parameter for that to see that what is the control?
No, in under your business combination, a company acquiring a company will only be covered. If you are acquiring a firm, that will not be covered.
LLP is
Right.
also, even though it's a body corporate, it's not covered.
Yeah, even for body corporate also, it will not be covered, because body corporates might not be having any shares. What you will acquire, right?
Okay. Okay. Yeah.
So that is why it can only be a private company acquiring a private company acquiring a public company, or the vice versa. But it cannot be a firm, or it cannot be any body corporate, or it cannot be any cooperative society for that matter.
Thank you.
Yeah. Now moving on to our last accounting standard, that is IFRS Ind AS 109, that is on financial instruments. Yes, so let us start with the financial instrument. So in this, first of all, we will understand what do we mean by a financial instrument. So a financial instrument can be a financial liability or it can be a financial asset also. So a financial instrument is a contract that gives rise to both a financial asset of one entity and a financial liability of one entity. That is, suppose if there is any financial instrument, one party will be paying the cash and maybe the other party might be issuing the equity shares in return of that. So it will be an asset to one company and a liability to the another company. Now, what do we mean by a financial asset? A financial asset is an asset against which you have to pay cash, against which you have to issue your equity instrument of another. You will be getting the equity instrument of another entity. Contract, you have the contractual right to receive cash or another financial asset, or in exchange of the financial assets or liabilities under potentially favorable condition, or the financial asset is an asset that are being settled in the entity's own equity. So that means financial asset is an asset against which you will be receiving the cash, you might be receiving the equity instrument of another entity, or you have a contractual right to receive cash or other financial asset of an entity. Like if I take example of your inventory, inventory is an asset against which you will be getting the cash, right? Or PPE is an asset, your plant and machinery is an asset against which you will be getting the cash. So let us understand with the help of few examples that what falls under financial asset and what does not fall under financial asset. Investment in equity shares. Yes, under if you are doing the investment under equity shares, it will be called as your financial asset. Investment in bond and debentures, it will be a financial asset because you will have contractual right to receive cash. Loans and receivable, yes, it is a financial asset. That means you have given loan to somebody else. And once you give the loan to somebody else, then that person will be repaying the money to you. So it will be considered as your financial assets. Deposits given. Suppose if you have given security deposit to somebody, that person will be returning that money to you. So it will be considered as a financial asset because you will be getting the cash against that deposit. Trade and other receivables, you have your debtors. So against those debtors, you will be receiving, you have sold the goods or you have provided the services to your debtors. So now you have to get cash from those debtors. Perpetual debt instrument held, this is also your financial instrument. Cash and cash equivalents, yes, like if you have you have invested in fixed deposit, so when that maturity will come, you will be getting the cash against that fixed deposit. So that is again a financial asset. Bank balance, financial asset. Inventories, not a financial instrument, does not fulfill definition, no contractual right to receive cash or other financial asset. PPE, not a financial instrument. Why? Because it does not fulfill the definition, no contractual right to receive cash or other financial asset. Intangible asset, not a financial instrument. Prepaid expense, not a financial instrument. Advance received for goods and services, not a financial instrument, because if you take an example of advance received from goods and services, so for this you have received an advance and now against that advance you have to provide the services. You do not have to provide, you will not receive any cash, but what you have to do, you have to provide the services. So that is why it is not a financial asset. Gold is not a financial instrument, does not fulfill the definition. Though gold is a highly liquid investment, it does not represent the right to receive cash or other financial asset. Now let us understand what do we mean by financial liability. It is the contractual obligation to deliver cash or another asset. So that means your financial asset is basically the opposite of financial liability. Financial liability is the opposite of financial asset. So financial asset is where you have to receive cash or you have to receive the equity instrument from some other party. However, if you talk about financial liability is when you have to pay cash or you have to issue equity shares to somebody, that is called as your financial liability. Let us understand with the help of some examples. Deposits received, it is a financial liability. Trade and other payables, it is a financial liability. Mandatory redeemable preference shares, it is a financial liability. Finance lease obligation, it is a financial liability. Financial guarantee, it is a financial liability and financial asset both. It can be both. Deferred revenue, not a financial instrument, because against the deferred revenue you will be getting the, or you will be selling the goods or the services. Warranty obligation, no, against this you will be providing this service, you will not be exchanging anything in cash. Income tax or deferred tax, not a financial instrument. Now let us understand with the help of a case study. Contractual obligation to deliver cash or other financial asset. ABC Limited, a high-profile company, has a strong history of dividend. The subscriber to receive shares expect the regular dividend payout, and it is highly probable that the company will pay the dividend on regular basis. Whether the payment of dividend is a financial liability? No, because we do not have any financial obligation. When your financial obligation will get arise? Financial obligation will get arise once you announce the dividend. The moment you say that yes, the company has earned a lot of profit and we announce that we will give 10% dividend to our shareholders, then it becomes your contractual obligation to pay the dividend. But till the time you don't announce, you do not have any contractual obligations to pay dividend to the shareholders. Now coming on to what do we mean by equity instrument? Equity instrument is basically the instrument which gives you right towards the assets and the liabilities of the company, because that basically gives you right in the company. That is why your equity shareholders are called as your residual stakeholders. So equity instrument contrasts that evidence a residual interest in the assets of an entity after deducting all the liabilities. That is why we say that equity shareholders gets only the residual amount, right? So equity instruments are the instruments which give you the residual interest in the assets of an entity after deducting all the liabilities. Examples could be equity shares, preference shares, warrants, written call options. Now let us understand the classification of financial instrument. This classification is very important because basis this classification only, you will be doing the treatment of your various financial instruments. So we have two types under your financial assets and under your financial liabilities. So under your financial assets, we have three types of classifications, and under your financial liability, we have two types of classification. Under your financial assets, we have three types of classifications, like that is amortized cost, fair value through other comprehensive income, and fair value through profit and loss. Under your financial liability, we have two types of classification, amortized cost and fair value through profit and loss. Fair value through profit and loss is generally the residual category. That is, if anything is not getting covered in these two, will get placed under FVTPL. Similarly, if anything is not getting covered under amortized cost, will get covered under FVTPL. Now let us understand more in detail about these three classifications of financial assets. So as I mentioned earlier, financial assets gets classified into amortized cost, fair value through OCI, and your FVTPL. How we will assess whether any particular financial asset will be classified under amortized cost or FVOCI or FVTPL. For this, we have certain criteria to fulfill. Like for amortized cost, it says that there are two criteria. Business model test, that means the company has this objective that once we do that we have a particular asset with us. So the objective is to hold that asset and to collect the maturity amount. And the maturity amount that we are getting will be the solely payment of principal and interest. So if these two criteria fulfill, then yes, it will be called considered under your amortized cost. Like if I give you an example of security deposits given. So security deposits given will be the pure play case of your amortized cost. How it will be the pure play case of your amortized cost? Because if you have given 100 rupees today as your security deposit, you will be getting those 100 rupees back maybe after 5 years. So that means we can say that if we see that there must be some time value of money concept involved in that 100 rupees. So that 100 rupees fulfills the criteria. What does it say? That we have a business model that we will hold that financial asset and we will collect the maturity amount, and that maturity amount is a combination of our principal and interest. So that is why your security deposit is falling under your amortized cost method. Then coming under your FVOCI. FVOCI, what does it say? That we have our business model where what we will do, we will hold to collect and sell. How we will collect we will hold the instrument, we will sell, and once we sell, at that point in time only we will collect the money. So that means in amortized cost, the objective was to hold the instrument and to collect the maturity value. But here, what is the objective? The objective is we will hold the instrument, we will sell the instrument, and then we will collect the selling price of the instrument. And what will be the selling price? The selling price will be again solely the payment of principal and interest. Now, whatever is not falling under these two categories will fall under FVTPL. Now coming on to the example, that suppose for your amortized cost, how it is being calculated, you need to first of all recognize the fair value. You need to subtract the principal repayments that you have done, if any. Then you need to subtract the cumulative amortization less the impairment, and there comes your amortized cost. So for your simple understanding, you can take the example of your of security deposits that you have given. That will be pure play considered as your amortized cost, because once your maturity of your lease agreement will come, you will get the money back, and that money will be having the component of your principal and the interest. So here it says financial asset classified as subsequently measured at amortized cost if it meets both the following criteria: hold to collect the business model test, and SPPI, that is contractual cash flows characteristic test. These two criteria should be met. Let us understand what is FVOCI. Other comprehensive income comprises items of income and expenses that are recognized in P&L as required or permitted by other IFRS. Certain examples, the items that are covered under OCI are gain or loss on hedge of a net investment. So these are the things that has been prescribed by the accounting standards. Net movement on cash flow hedge, net gain on loss on FVTOCI, debt instrument, debt securities, exchange difference on translation of foreign operations, items which are not reclassified in P&L. So that means this is the items which will be reclassified to P&L even in subsequent period. But items which will not be reclassified to P&L in the subsequent period are remeasurement gains on losses on defined benefit plans, revaluation of land and building, and net loss or gain on FVTOCI equity securities. So if you guys have idea about OCI, other comprehensive income is basically the extension of your P&L. Like earlier we used to have a profit and loss account. So now other comprehensive income is nothing but it is an extension of your P&L. So your schedule 2 has prescribed that what all items can be reclassified to P&L and what all items cannot be reclassified to P&L. Reclassification to P&L means they will move from OCI to P&L. And the items which cannot be reclassified to P&L, they cannot be moved from OCI to P&L. They will remain in OCI itself. FVOCI debt instrument, financial asset is measured at fair value through OCI if it meets both the tests, that is hold to collect and sell business model test, plus the SPPI test, which we have already discussed. That is, here the objective is to hold and sell the asset, and then you will be realizing the the value, and the value will be your solely payment of principal and interest. See here it says the objective is achieved by holding the financial asset in order to collect the contractual cash flows and selling the financial asset. And whatever amount you are collecting that amount with respect to your principal and interest payment. Then coming on to the case study, let's discuss it with the help of a case study. So entity has a surplus fund of 10 million. A has not yet found suitable investment opportunity, so it buys medium dated 3 years maturity high quality government bonds in order to generate interest income. If a suitable investment opportunity arises before the maturity date, the entity will sell the bonds and use the proceeds for the acquisition of a business operation. It is likely that a suitable business opportunity will be found before the maturity date. So that means now we are saying that we have a bond and we are holding it, and we see that yes, we will have an opportunity to sell that asset and we will be getting the good amount against that bond. So that means government bond would not meet the hold to collect business model test, because it is considered likely that the bonds will be sold well before their contractual maturity. So that means bond is something what the investor will do. Investor will see that when I am getting the highest return at that point in time, I'll sell that bond, I'll realize the sale consideration. So it is likely that such investment would meet the hold and collect and sell business model test. Now coming on to the debt instruments. For debt instrument classified as FVOCI, accounting requirements are as follows: interest income to be recognized in P&L, credit impairment losses or reversal to be recognized in P&L, other changes in the carrying value to be recognized in OCI, and recycling to P&L. Cumulative fair value gain or loss recognized in OCI is recycled to P&L. Moving on to the financial assets classified as FVTPL. This is one of the residual category of your of classification of financial asset. It says that fair value through profit and loss is the residual category in IFRS 9. Fixed asset classified and measured at FVTPL. If fixed asset is held for trading, a debt instrument that do not classify at amortized cost or FVOCI, equity instrument which is not elected to classify as FVOCI, then it will be covered under FVTPL. If we take an example of the fixed financial asset that are accounted for at FVTPL, like your interest rate swap, commodities, futures, if you have any investment in mutual fund, that also will get covered under FVTPL. If we see a case study, entity B owns 5 retail chain. It sold one of its retail chain to entity C. As part of the purchase consideration, entity B is entitled to additional consideration of INR 3 million. If the retail chain meets certain project profit targets over the next 3 years, how should entity B classify the contingent consideration receivable? They will account for the terms of contingent consideration receivable fails the SPPI cash flow characteristics test because the payment is linked to future profitability. So that means it will fall under the residual category of FVTPL. Classification of financial liability. Here we only have 2 categories. We do not have FVOCI category. So we have default category of amortized cost and we have FVTPL. This is going to be the default category and this is going to be the residual category. So if category which are financial liabilities have been classified into 2 categories, like your fair value through FVTPL, what is the main use? Financial liabilities that are held for trading will get covered under FVTPL. Financial liabilities that are designated as FVTPL, the entity on initial recognition. If at initial recognition you have taken an option that you will classify certain liabilities as FVTPL, then those liabilities will be classified under FVTPL. Amortized cost, all liabilities which are not falling under your FVTPL will get covered under amortized cost, like your trade payables, your bank borrowings, loan that you have taken will get covered under amortized cost. Recognition and measurement. At initial recognition, an entity shall recognize a financial asset or financial liability in its statement of financial position as and when the entity becomes the party to the contractual provision. When an entity first recognizes a financial asset, it must be classified as amortized cost, FVTOCI or FVTPL. This is what we have discussed. Subsequent measurement, financial asset, subsequent measurement. Again, at subsequent measurement, there will be 3 criteria. Amortized cost, this won't be relevant, but here change in the fair value is recognized in OCI and it will be recognized under PNL. So under amortized cost, there won't be any change in the fair value, but here, because these are based on your fair value, that is fair value through OCI and fair value through FVTPL, whatever the changes in the fair value that you will have will be recognized. Here it will be recognized under OCI and here it will be recognized under profit and loss only. For financial liabilities, whatever fair value change will happen on subsequent recognition. By subsequent recognition, what we mean is, suppose you have acquired an asset during the year, maybe on 1st July, you have acquired an asset. Now you are standing on the reporting date, that is balance sheet date 31st March 2021. So you will do the reassessment at your 31st March 2021, which is called as your subsequent measurement. So here under your FVTPL, if there is any change in the fair value, that will be recognized under FVTPL, under your PN, profit and loss only. And if there is any amortized cost, in amortized cost, there will not be any change in your fair value. So this won't be relevant. Now, coming on to your liability or equity representation. Liability or equity representation means, so if there is any combined instrument which has a liability and equity portion both, so how the presentation will be done? So financial instrument shall be classified as liability or equity in accordance with the substance of that contractual arrangement. Some financial instruments may take the form of legal form of equity, but are in substance liability. An equity instrument in any contract that evidence a residual interest in the assets after deducting or liability. So if you have heard of any fixed to fixed criteria, so if there is any instrument which has both liability and equity portion, so how we will be assessing whether we have equity portion or whether we have the liability portion. So for this, the accounting standard says that if you have fixed to fixed criteria, that means suppose you are holding maybe any convertible debentures and the agreement says that against those convertible debentures after 5 years, you will be getting 1:1, you will be getting the equity shares in 1:1 ratio. So 1:1 ratio means that if you are holding 1 debentures, in exchange of that one debenture, you will be getting 1 equity share only. So here you have the fixed to fixed criteria. That means against the fixed number of debentures, you will be getting the fixed number of equity shares. But if that fixed to fixed criteria is not getting met, like if it says that against those 200 debentures, you will be getting the equity shares, which will be depending on the market price that will be existing on that date. So that means now it is not a fixed to fixed criteria because you do not know what is the price that will be prevailing at that date. Settlement in own equity instrument. A contract is not an equity instrument solely because it may result in receipt or delivery of entity's own equity instrument. A financial liability will arise when there is a contractual liability to deliver cash or another financial asset to exchange your financial assets or financial liability under conditions that are potentially favorable to the users. Now let's see the variable number that I was discussing. There is a non-derivative contract to deliver or be required to deliver a variable number of own equity instrument. Right. So as I mentioned in the second example of debentures, against those 200 debentures, you will be getting the equity shares, but you will be able to determine the number of equity shares only on the basis of the price of the equity shares that will exist on that date. So that means Now there is a variability in the number of equity instruments that you will be getting. Second is there is a derivative that will or may be settled other than by issuing a fixed number of own equity instrument. Now here we are talking about that is the one-on-one criteria, that against those 200 debentures you will be getting 200 equity instruments only. So how an instrument will be classified as equity? An instrument is an equity if and only if both the conditions are met. The instrument includes no contractual obligation. If the instrument will or may be settled in the entity's own equity instrument, it is a non-derivative that includes no contractual obligation for the issuer to deliver a variable number of own equity shares, that is fixed number of shares. You will be getting the fixed number of shares. So wherever you are getting the fixed number of shares, you can easily say that if the number of shares that I am getting is fixed, then the instrument will be classified as an equity instrument. So see, equity instrument, no obligation to pay cash, not a financial liability. You are issuing your own equity shares, variable number of shares if they are there, then it is a liability. However, if you are getting fixed number of shares, that is fixed to fixed criteria is getting met, then the instrument is your equity instrument. Now let us understand with the help of this case study. The fixed number of shares, ABC Limited enters into a contract to deliver 5,000 of its own ordinary shares to a third party in settlement of an obligation. Here you have fixed number of shares. Since the number of shares is fixed, this is an equity instrument. PQR Limited enters into a contract which requires to settle a contractual obligation using its own share in an amount that equals the contractual obligation. So that means here the number of instruments are not fixed. So that is why this will be your liability. This will be your financial liability contract. Variable number of shares, XYZ Limited has an contract option to buy gold. If exercised, it will be settled on a net basis if the company shares based on the share price at the date of settlement. So then, because see, over here what it is saying, A Limited has an option contract to buy gold. If you exercise it, it will be settled on a net basis in the company's shares based on the share price that will be existing at the date of settlement. So that means here also we have the variability in the number of shares that we will be getting. So that means over here also this instrument will be classified as your financial liability. So only in the first case where there was a fixed number of shares that are being offered, it will be considered as your equity instrument. Rest in both the cases, it will be considered as your liability. Now coming on to reclassification from equity to financial liability, what we need to do, we need to de-recognize the carrying amount of equity instrument, recognize the liability at your fair value, and difference between the equity and liability shall be recognized in equity. Example, ABC Limited perpetual shares for $100 that carry the right to receive discretionary dividend. Discretionary dividend means you will be classified as equity. Why? Because equity shareholders are the one who gets the discretionary dividend. That is, if the company would like to pay the dividend, the company will pay, but the company does not have any contractual obligation to pay. ABC Limited amend the terms such that the redemption is required in the event of a change of control of the company. Fair value of the perpetual shares is $120. On reclassification, recognize an adjustment in equity for $20. So that means here it is a case that earlier you had an equity. That equity has been changed to liability. So what it will do is you need to recognize the difference between the equity and liability shall be recognized in equity. Vice versa case, if it is there, de-recognize carrying amount of financial liability, recognize equity instrument. Just 1 minute, please. Yes. So with respect to the reclassification from liability to equity, it says that you need to de-recognize the carrying amount of financial liability. You need to recognize the equity instruments at fair value if they are reasonably measurable, or if reliably measured, or if not reliably measurable, then you can recognize at the fair value of de-recognized liability also. The difference between the carrying amount of financial liability and the amount that you are recognizing for the equity instrument, the difference of these two will go in your P&L. So that means when you were declassifying from equity to liability, you were taking the difference into equity. But when you are reclassifying from liability to equity, your difference will go to P&L. Compound instruments are the one where you have both the substances, that is liability and equity both. So compound financial instrument has a legal form of a single instrument, whereas the substance is that both liability and equity instrument exist. The issuer of a non-derivative financial instrument should evaluate the terms of the financial instrument to determine whether it contains both a liability and an equity instrument. Such components are classified separately as financial liability, financial assets, or equity instruments. So compound instruments are those where you have both the things, liability and equity. Example, your preference shares with discretionary dividend. So preference shares with discretionary dividend means, the word discretionary dividend means it is having the component of equity also. But principal redemption liability, because preference shares, for the preference shares you will have to provide the you will have to provide principal redemption to the preference shareholders, because when you redeem preference shares you will be getting the dividend and you will be getting the principal amount back as well. So that is why it has both liability and the equity component. Convertible debentures, here you need to see that your conversion option to the holder will become your equity liability, and your principal redemption and interest payment liability will be your liability component. Because when you convert any convertible debentures, so generally it has an underlying instrument that against those convertible instrument we will be issuing, maybe against your 5 convertible bonds we will be issuing 5 equity shares after 5 years. So that conversion option is giving you the right in the company. So that is why, plus it is giving you the fixed to fixed option. So that is why it is called as your equity component. Now coming as, when you have a compound instrument and you have both financial liability and equity, how you will do the accounting? You need to do the split accounting in that case. Split accounting, issuer of compound instrument classifies the liability and equity instrument of the compound instrument separately as financial liability and equity. So you need to account for separately financial liability and equity. How you will account for? Fair value of entire compound instrument should be determined. Determine the fair value of liability component included, and the residual will be the equity instrument. So that means, suppose if you take an example that you have a convertible bond, the fair value of that convertible bond is 100 rupees. So what you will do, you will assess the fair value of that liability, and the residual value, that is fair value of the compound instrument less the fair value of your liability component, is equal to the fair value, residual value of an equity. So you need to assess the fair value of your compound instrument and the fair value of the liability. The difference will come out as your residual value of an equity option. Like case study, company J issues 2000 convertible bonds. The bond has a 3-year term and are issued at par with a face value of 1000, giving proceeds of 20 lakh. Interest is payable annually in arrears at a nominal interest rate of 6%. Each bond is convertible at any time up to the maturity into 250 ordinary shares. So this means there is a fixed criteria that against these 2000 bonds, we will be getting 250 ordinary shares. So that means this is a compound instrument. We have equity and we have liability both. When the bonds are issued, the prevailing market interest rate for similar debt without conversion option is 9%. The entity incurs issue cost of 1 lakh. Let's see. So the split accounting would be, you will be getting the interest of 1,20,000. That is you have issued 6% and your total proceeds is 2 lakh rupees. So that means 1,20,000 interest. You have a term of 3 years. So in the first year, 1,20,000, second year, 1,20,000, third year, you will be getting the maturity. So that means you will be getting 20 lakh plus 1,20,000 rupees. What is the discount factor that it has asked? What is the conversion option? 9%. So you will apply the 9%. This has come out to be the present value. So now what is the value? Value of your equity would be balancing figure. This is the value of your liability component. Total proceeds that you will be getting against this bond is 20 lakh. So the balancing figure, that is the value of equity component, is 151,878. So this is the net. This is the value of your equity component. What it has stated is the residual value of equity component. So that means total proceeds, that is the bond's fair value, is 20 lakh rupees. The liability component that we have calculated is 18,48,000, and the balance is the value of your equity component. Now allocation of transaction cost between equity and liability. So now we have the values with us. So what we have to do, we have to simply allocate the transaction cost. The transaction cost is 1 lakh rupees. So what we will do is we will simply allocate gross proceeds 180,48, and we will have to, what we have to do, we have to allocate this transaction cost in the ratio of 1,848 and 1,518. So in this two ratio, you will divide your issue cost, and the net will be your net. And if you subtract your gross proceeds less your issue cost, will come as your net proceeds of liability portion and the net portion of your equity component. So this is how you need to do the accounting of your compound instrument. So have you understood? Any questions? I know that financial instrument standard is a bit complicated standard. It is not so easy to understand this standard. In fact, financial instrument is a standard where you need to read a lot, you need to understand a lot. So yes, this is one of the complicated standard. Yes, anyone have any questions for me? No? So then I think your next session is from what time? It's from 12:30. Let me just check. Yes, your next session is from 12:45. So I'll ask Mehak to get in touch with you guys. Maybe if you want to take the break till then, you can take your break. And in the meantime, I'll also share the slides with Mehak so that after the session, whenever you want to go through the slides, you can go through the slides for your examination purpose as well. Okay. Okay, then thank you so much and all the very best for your examination. Thank you. Take care.